and welcome to this update. So today we need to discuss the baseline civil contractors case. And really the case deals with something that for the life of me, I don't know why it ended up in the SCA. I've been saying what the court said here in the SCA. I've been saying this since at least 2020 when the first version of my book was published on this topic. And so honestly, I read this SCA judgment, I thought to myself, why it went all the way to the SCA, I don't know. Taxpayer lost, rightly so, but the message is not, I'm not glad the taxpayer lost, I'm glad about the certainty in law that it gives, and it points out to certain things that we can avoid as tax professionals and tax practitioners and taxpayers. As per usual, this training is intended for my staff and those joining online, really just for your interest's sake. All right. So what is this judgment by the SCA, right? So the taxpayer is in civil construction and it is a partner in an uncommon detailed partnership. Doesn't really matter, that sounds more so fancy. All it means is the taxpayer is in a partnership, right? And it declared gross income of 320 million and it had expenses against that of 73 odd million. Now included in that 73.2 million was an 11 million rand profit share, right? Which it described, in short, is what it described as the partnership profit that it has to pay to the other partners in the partnership, right? Because obviously it said, well, I made some income in this partnership, but I have to declare some of this to, or distribute or share, if you will, in terms of my partnership agreement with my partners, I need to share that, right? So SARS originally assessed them and they allowed this expense because as normal assessments go, the system will just allow it as an expense, but eventually SARS did an investigation and they said they're going to reverse the expense, right, of 11 million rand, right? So now they go and they lodge an objection, and this is crucial to understand because yes, it is possible to screw up an objection. And yes, it can cost a taxpayer dearly, as it did in this particular case, right? So they lodge an objection, obviously not an objection that was properly thought through, probably one that was just rushed for the sake of getting it in, I don't know, but the point is they object to this decision by SARS to reverse the expense, right? SARS disallows it, they go and appeal in terms of Rule 10, and they eventually end up in litigation with SARS delivering their statement of grounds of assessment or their Rule 31 statement, and the taxpayer then responds, right? And what the taxpayer responds in his Rule 32 statement, and this is typically where people go to people like us, taxpayers come to people like us and say, oh, now all of a sudden it's important because I'm actually going to court, I need someone to check if my arguments are right. We say your arguments are shit. Right? You need to introduce, because you're going to lose on those arguments, right? So we need to add something because we don't really have that strong of a case on that basis, and that's what I think happened here, is somebody helped them and they said, yeah, I hear your expense ground, so you've got this obligation to pay the partner in the partnership, but that 11 million is earned in terms of the partnership agreement, and so if truly that is partnership revenue, then it's not beneficially received by you, nor is it accrued to you, right? And they add that to their Rule 32 statement as a basis, right? And the issue ultimately in dispute is whether or not the taxpayer is allowed to add that as a new ground to their appeal. And this is typically the issue. It cuts both ways, right? We've discussed, I think last week or the week before that, on SARS' side when SARS can add new grounds, right? This is now when a taxpayer can add new grounds. And SARS is saying, okay, look, when you declared in your tax return your revenue of 370 million, including that 370 odd million was 11 million rand, you declared that as a receipt in your tax return. Your objection did not challenge that inclusion in gross income. Your objection challenged the deduction. So your objection had nothing to do with the revenue side of things. Your objection had to do with the deduction side. And what Rule 32.3 does is it prevents the taxpayer from, at pleadings phase, to introduce effectively a new objection, right? And if the court were to allow the taxpayer to add this deduction argument it will undermine the objection process and prejudice SARS, right? Taxpayers' arguments in this I found quite fascinating. If you actually know, well, I'll just be careful. If you are familiar with the concept of what an assessment is, and this goes back to the first South African holdings case. This is, and even before that, I forget the case name, but it seems people have just decided that they're going to ignore what the meaning of assessment is. Because this argument, for me, on my interpretation, is a ridiculous argument. And the argument that they're trying to make, as they said, that is my understanding, is when you look at the Rule 32, it says you cannot object to part of the assessment not placed, or amount not placed under objection. And they say, but it's the same amount. It's the 11 million rand in gross income and it's the 11 million rand in deduction. Now it's the same amount. It's not an impermissible new ground for appeal because I'm still objecting to the same amount, albeit an alternative basis, but it's the same amount. But that, with respect, completely misses what an assessment is. And that was, in my mind, abundantly clear already in 2010 and already from the first South African holdings case. And so this, to me, it sounds to me like a bit of a stretch of an argument. Now, the question I always ask is, why do you go all the way to the SCA to add this ground? Because you think you're going to lose on the expense ground. That's why. Otherwise, you would not have gone all the way to the SCA. And that's the crucial point, right? But they were trying to say that I'm still objecting to the same amount. But when you read Rule 32 and you read Rule 7, it says you must object to the amount, or you must set out the grounds for objection and specify the amount or part of the assessment objected to. And that follows through to Rule 32 that says, you know, what amounts have not been placed under objection. That's why when we take a case on at appeal stage, one of the first things we look at is the NOO. Give me the form. I want to see what boxes that you tick in terms of which amounts are you placing under objection. And indeed, sometimes the boxes don't make provision for everything, right? But then we've got the annexes and the detail, which is where we'll typically set out. So I'm objecting to this, I'm objecting to that, I'm objecting to that, right? The taxpayer also tried this policy argument to say that, look, ultimately, and this is something, as soon as you see someone going down this, oh, it's a policy argument, it means they know they're weak on the wording, right? Because they're trying to find a way around what is obviously not permissible or not that is weak in argument. Not always, but sometimes. So when you say, all right, the policy argument is, but the tax court should ultimately be able to determine what the correct tax liability is, regardless of whether it's a deduction or whether it's an inclusion in income. And this strict procedural requirement will undermine that concept. And the court made swift work of this and said no. That is not, unfortunately, how the rules work, right? As I said before, the court says, and this is what I've been saying since 2020, you must place the particular amount under objection, and that amount you can continue with on appeal. You can add new grounds relating to that amount. And it's not a question of whether it's the same figure. That's what I understand the taxpayer was trying to argue, but it's the Salanomar, so who cares? Let's not split hairs about technicality. Unfortunately, tax dispute resolution is all about technicalities, right? And so the answer is, the amount that you placed under objection was the deduction. You did not place any expense under objection, and so therefore you cannot, it's not an elaboration or something that was placed under objection, the assessment meaning the calculation of gross income. The taxpayer could have. They could have said, I'm object, even though they declared it in their tax return as gross income, they could still have objected to it, right? In fact, the court in GB Mining said that you can object to an assessment if you are yourself your grievance of the assessment. So indeed, the argument should have been you should have objected to it, right? And you didn't. And so now you're unfortunately barred from doing this, right? And what the judgment further says, the SCA says, is the reason why we have these rules that limits taxpayers, and indeed SARS, this one was particularly a case that limiting the taxpayer, is so that you don't have litigation by ambush in tax court, right? This is not America, right? You don't come up with something there in court that nobody's seen before with a smoking gun and try to be dramatic. That's not how the South African system works, right? What the court says is, he says the two grounds that the taxpayer was trying to argue, because he had the expense ground that they've been persisting on since the objection, and then they wanted to add this appeal. He says, but those two grounds can't comfortably coexist in the context of this case. And I'll tell you why I say that, because I have a case now where exactly this issue has come up, and I'll explain to you how we pitched it, and to the guys listening online. And what the court said, if they wanted a reduction to gross income, the proper place to do that is not in a Rule 32 statement. The proper place to do that is go back and object, time permitting, or request a reduced assessment, time permitting. But you cannot, the same way that SARS cannot make out a new case at pleading stage or a new assessment, they must go back and they must go through the process of raising the assessment. And I've got that Erasmus judgment, we're discussing that next week, but you read the article where I make the same point, right? They cannot invent a new case at pleading stage, right? So, I just want to see what I've got here. Yeah, the appeal was dismissed with costs, including those of to counsel, right? So here is the practical takeaway of this. The reality is you can screw up an objection. Very much possible, and it could cost the taxpayer dearly. And I'll take you through an example. I've spoken to you guys about the example when I read this judgment about a couple of weeks ago. Is we have a case where the taxpayer had a deal with someone where they would invoice them based on forecasted expenses. You remember, I'll be careful now because I'm online, so I just want to give away the taxpayer. So they would forecast based or they'd invoice based on forecasted expenses, and to the extent, because they had two levels of invoicing. The one was to cover expense, the one was a profit element, right? And so they would forecast the expenses, and let's say the expenses was 100 Rand, right? And they would go to the client and say, here's an invoice for 100 bucks, right? And the client would say, here you go, here's 100 bucks. If at the end of the quarter, it turns out your expenses were only 80 Rand, you must refund me the 20 Rand, right? So, and that's the way they did it, right? Not entirely, but that's the way it kind of panned out. And the way they, for accounting records, treated this transaction is they said, well, okay, I'm going to raise the revenue of 100 Rand because I invoiced for it, and I'm going to raise a provision in my balance sheet through the income statement, but through the income statement to the balance sheet provision for client refunds, or right, because they know that they have to actually pay that back. And they don't reverse that provision, and the tax compensar says, I'm disallowing that expense. That is simply a forecasted expense. That's not a properly deductible expense. Now, these guys, if I follow the approach that they did in the objection, I will object to that assessment and simply say, the expense is deductible. I have an obligation under the contract to pay this 20 Rand back to them because it's there. The contract is there. It does say that. And that will be where most people stop, right? But that's not what you should do. What you should do is you would say, okay, if we understand the meaning of the word assessment, properly so called, and we know that it's the different determinations, the different line items, then we must say, okay, fine. We know that ultimately our objection is aimed at reducing the bottom line taxable income, in the case of income tax, or in the case of VAT, reducing the VAT payable bottom line, right? SARS might have reversed expenses, right? But if I can decrease the bottom line by decreasing revenue, I'm adding that to my objection, right? The same with VAT. SARS might have said, I'm standard rating your exempt supplies, fine, but then I should be entitled to input tax. So in addition to arguing, no, it's exempt, I'll also argue, but then there must be an adjustment to my apportionment. Because you have to add that, because the fact that you place that amount on the bottom line has got the same, you can't say it's the same effect on the bottom line, therefore it's a permissible new ground. You have to literally sit and think about the case, and that's what we do. Right? Is we sit with the case and say, fine, what possible angles can I take to hit the bottom line? Can I take a gross income angle? Can I take an output tax angle? Can I take an input tax angle, deduction angle? So in the case I was referring to, we went in with it's not gross income, right? Alternatively, it's deductible. Alternatively, it's a 24C claim. And the way we pitched that argument, and we will sit with ADR soon, right? And I'll say to SARS, because the way that, and I did that on purpose, because I was forcing them to effectively fall on their own sword with the 24C. Because what they said to me is, no, it is your income, because you received it in terms of a contract. And yes, we can see it's an expense, but it's not an expense in this year. Then I said, but thank you. Take your sword and fall on it, because that's exactly the requirements for 24C, which means I win my case anyway, right? So that's the way that you should think about a case, because it's not just about what is in front of you. It is about how we get to the bottom line and what things that we must place under, what did I do? So that's the bottom line of this case. is make sure that you place everything you can under objection. And the starting point, when we look at cases, of course, when we do it, that's slightly different because we tend to be as comprehensive as we can be. But when you take on a case from someone else who did the objection, the first thing you go and check is what did they actually place under objection. Because a big issue that I often find with taxpayers is on understatement penalties. They will fight the assessment, and then they will believe, so let's say SARS makes an audit adjustment. So let's use disallow the expense. Right? And they will fight then that expense on the belief that that expense they will get it. And then that the penalty will then indeed automatically fall away by operation of law. But what if you fail? What if you fail on your expenses? That means you made no case for understatement penalties, and the understatement penalty will stand. And then you will come to me on appeal and say, yeah, okay, I accept I can't claim the deduction, but they want the penalties. I said, well, I cannot take it on appeal. We'll have to go check if we can open it up in terms of objection again, or reduce the session, or whatever the case might be, but we cannot add it to appeal. It will be called out, and we will end up with a striking out application against us, which is just going to cost you a hell of a lot of money and 3 years worth of time that we waste. So there's no point, right? So check. You can add any new ground as long as it relates to an amount that was placed under objection. And this is something that has been, unfortunately, quite a debate for many years, even despite the fact that since 2012, the position as I've explained it here is as I've explained it here, since 2012 when the new tax court rules were introduced. The earlier version of the tax court rules, right, the ones that preceded the TAA, had similar provisions in the sense that it would allow you to, on appeal, add new grounds, but it was very unclear as to what exactly is permissible and what is not. And the way it read is, it read that SARS must set out the grounds on which it relies, and the taxpayer must set out the grounds on which it relies. So the courts interpreted that set of rules to say, well, it means because those phrases or those pleading paragraphs were drafted in the present tense, SARS can rely on anything, right? And then there was a debate about whether that's fair and whether SARS can novate the factual legal basis of their assessment, and the same with the taxpayers, what can they add and what can they not. So the whole issue of what is permissible and what is not is, in my mind, has been clear since 2012. But because we've got this legacy jurisprudence on the previous set of the rules, I think there are still some people in SARS that forgot that the rules have changed since 2012. In fact, we had a meeting with, I don't know who of you sat in that debt collection, don't mention client names, but who sat in that debt collection meeting where they said you cannot do a suspension of payment if you have not yet objected. Who was in that meeting? Right, which is absolute nonsense. The person who said that clearly last looked at the legislation before 2012, because that's how it read in 2012. Right? So unfortunately, it seems the guys aren't really, not all of them of course, but some of them are simply not up to date. All right, let's take questions. If there are any questions from you guys first, and then we'll go to the online guys and see if there's questions online. We've discussed this kind of internally already, because we can't wait 2 weeks, because we've got stuff to do, but do you have any questions?
Yeah, I'm curious. Like, you know when you're filing an objection, e-filing, and then you tick amounts there.
Yeah.
But then maybe let's say in your cover letter you don't have any grounds for maybe 1 or 2 of the amounts that you've already ticked. In appeal stage, can you then?
I think you can technically. It becomes a bit of a technicality, because if SARS does not invalidate that part of the objection, then I think you arguably can. Because when you read Rule 7 carefully, it says you must provide the grounds for assessment for every part that you're objecting to, right? So Rule 7 actually reads like that. So technically speaking, if you tick an amount and you don't provide grounds, because what is grounds? Grounds, when you look at it's facts in the law, right? And you must add substantiating documents in terms of Rule 7, which is the documents in support of your burden of proof to support your factual statements in your facts and grounds, or your facts and law for your amount that you're objecting to. So technically speaking, if you just tick amounts and you don't provide any grounds for it, your objection is technically invalid to that extent, right? If SARS allows it or disallows it, I suppose, and they don't invalidate it, then I think they've effectively condoned your non-compliance with the rules. And I've said that before. If SARS, in my book, I've got paragraphs about SARS not acting in terms of Rule 7.4 to invalidate. But if SARS has accepted it, they've effectively condoned it, because I think that's what Rule 7.4 allows SARS to do. Is it says that SARS may invalidate an objection if there's non-compliance with Rule 7.2, right? So and in my book I explain why I think that's a discretion, and me and Advocate Lowe had quite a discussion on it, if I remember correctly. But if they allow it, then you can add new grounds. I mean, it's something that they should not be allowing. But then what they allow and what they don't. For those of you joining late, if you are joining late, please note that these sessions are recorded. They are online on the Unicus YouTube channel. Does that answer your question, Aviwe?
Yeah, but I'm thinking, when you are ticking, they also write 0. Or maybe you specify an
What
amount
you
of
would
belief
Yeah.
you are entitled to. But obviously, maybe then in your letter, maybe you under the income or expense, you specify like, no, I acted this way.
Yeah.
I was honest, I relied on advice, but you don't put it under maybe
A step heading.
SP.
That's fine. That's fine. You've raised it. You've raised grounds for it. That's fine. I mean, it's not how one would ideally write a thing, but people do tend to write that way because they don't necessarily always have that structure, and they don't know that they necessarily need that structure. But it's a question of, like the court said in Endomeni, you have to read anything or interpret things in context and for purpose. So to follow that kind of no, there's not on a paragraph for that is too rigid an approach. It doesn't fit with the proper interpretation. Let's see, here's a question. Can the new ground result in a change to the amount that was initially objected to? For example, if an expense of 100 Rand was originally objected to and SARS partially allowed it, the expense of 100 was originally objected to and SARS partially allowed it, can the amount be revised to 150 during the appeal stage? Right, so that's an interesting question. I think if you asked for it in objection to be 150, we had something similar. Yeah, we're just thinking about those legal fees. You remember the case? So if you asked in the objection for the expense to be 150 Rand and they disallowed, then you can go on appeal for 150 Rand. If you go for 100 Rand on objection and it turns out they only grant 100 Rand, we had a case like that. The guy claimed legal fees of, let's stick with the example here, claimed 100 Rand in legal fees on the tax return. SARS disallowed it. We objected. SARS allowed the full 100 Rand. Then the client said to me, you know what, I actually had 150 Rands with the legal fees. So what did you put in your tax return? No. So what did we do? We went back in, did a correction, right? Or request a reduced assessment in respect, because that was not technically it wasn't claimed. It's not the same assessment. So no, I don't think you can argue that on appeal in the same way that SARS cannot argue for a revised assessment in appeal stage. They can't say, okay, I've assessed you to 100 Rand, now I'm going to assess you to 150 Rand. That requires the issue of a revised assessment. You can't do that. Right, I hope that answers your question.
For interest's sake,
Yes.
my question is based on like section 1010 exemption, right? Let's say a taxpayer, no, she's laughing. Let's say a taxpayer.
Have you guys discussed this already before?
Yeah, we
Okay.
actually discussed this before.
Okay. Sorry.
Okay.
Yeah.
Let's say a taxpayer then disputes the exemption parts, the deduction parts, and not the actual gross income line item, right? But they are now objecting that SARS didn't allow the exemption as per section 10102, and they qualify for 10101.
I think if you...
So the gross income was incorrectly declared in the first place. So the grounds for objections were incorrect.
So are you saying... Okay, so let me understand this. So I got you right. And it's for the people online as well, just to hear. So the guy filed a tax return, declared income of X, claimed an exemption in terms of 10101. 10102. Claimed an exemption in terms of 10102. Qualifies under 10101. Okay. And in the objection, they objected to the exemption not being allowed. I think that'll fly. Because I'm still objecting to the exemption that's not been allowed. It's just the legal basis on which I'm changing the legal basis for the exemption, but I'm still attacking that determination being the exemption that's not been allowed. It's the same kind of concept where I did, for example, say out of gross income fading that and expense fading that 24C. None of that was in the tax return, but I'm specifying those determinations as, or the lack of determination in the context of a 24C claim, I'm specifying those as that's what I'm disputing. So I think that should be fine. It is a fine line sometimes, and people sometimes get confused, but if you think about what is an assessment, it's still that exemption determination that you're taking issue with, so it should be fine. Any other questions from the guys online? No. That's it then for today. Thank you for your time. Next week we are discussing the Erasmus judgment, which looks like a GAR judgment, General Anti-Avoidance Rules judgment. It wears GAR clothing, but I think it's got far-reaching implications, or implies something very important about SARS's letters of audit findings, which is something I think most of you are familiar with. Right, so thank you for your time, and then we'll see you again next week, Tuesday, same time, same place. Thanks for listening. Ciao.